I'm Taylor Riggs in New York. This is Bloomberg Technology. Coming up in the next hour, former Uber engineer Anthony Levandowski is charged with stealing driverless tech from Alphabet's Waymo, adding a new chapter to the saga tied to the possible theft of trade secrets. Plus, smoke 'em if you got 'em. Philip Morris is in talks to reunite with Altria, how the potential merger could affect the e-cig market. And we speak to the co-founder of Apple, that is none other than Steve Wozniak. He discusses everything from trade to Apple's shift to services to his strong concerns with privacy on Facebook. But first, to our top story. Federal officials charging former Uber engineer Anthony Levandowski with stealing driverless technology from Alphabet's Waymo unit. This is one of the most intriguing recent legal battles in Silicon Valley and a top priority for the FBI.
The FBI will not tolerate the theft of trade secrets. And I want to be clear on what we consider trade secrets. These are the crown jewels of companies.
Joining me to discuss is Bloomberg's Eric Newcomer, who has covered this story really since its start. And what a long saga it has been. What did we learn today?
I mean, this was a total surprise. You know, Uber and Google settled this a couple years ago. You know, there had been a private arbitration, but the idea that there would be actual criminal charges against Levandowski had been something I think people had largely given up on. It's just taken so much time. So this is a big deal for Silicon Valley.
Talk to me about the difference between the two trials, because like you said, they had settled one arbitration, right, but this seems to be a criminal probe. What does that tell you?
Right. So it's about the idea that stealing trade secrets involves theft, right? It's not just about the harm to Google or the competitive advantage that Uber might have gotten relative to Google. This is just about fundamental laws and whether you can take things from your employer and use them for your own or someone else's economic benefit. And so that's really what the case is about here.
I think one headline that caught my eye was that they said the case is still very much ongoing, which leads me to think that there could be more people at risk here. Who else do we think might be involved?
Right. There aren't a lot of details in the indictment. So it covers a lot of ground we saw in the civil cases. So it'll be interesting to see what they found. You know, an obvious question here is that Travis Kalanick sort of recruited personally Anthony Levandowski to come to Uber. And so the question will just be, is there anything there untoward about what they agreed upon or talked about? Because Kalanick would be clearly sort of the higher level person here. Other than that, you know, Levandowski has been the central figure here. There's no reason to believe that Kalanick is under investigation or anything like that, but clearly he was a central character in the civil litigation.
So you talk about the characters. Remind me what's at stake. Who are these characters for people who haven't been following this for the last several years? What really are we looking at?
So Anthony Levandowski is a key figure in self-driving car research. He was at Google's Waymo for many years and then basically became impatient that they weren't making enough progress. Created his own startup, went to Uber, and then even after this huge blow up going to Uber and the suit from Google, went on to keep working in self-driving cars. So he's gone so far as to claim that he's working on a religion around artificial intelligence. So this is a sort of true believer in the most ridiculous sense of self-driving cars who is now at the center of a big criminal case.
So you said not a lot of details, but finally, though, any other big deadline that we expect to be coming up? What else are you looking out for?
You know, we're just hoping to get much more information about the case and what's different from the last time.
Perfect. Wonderful. That was Bloomberg's Eric Newcomer. Thank you for joining me. Another big story that we're watching, it is all about global tobacco giants Philip Morris and Altria. They are in talks to reunite after splitting up more than a decade ago. The deal could have big implications for San Francisco e-cig startup Juul, which Altria now has a stake in, and it could have some big implications for the global vaping industry and electronic cigarette regulation. Joining me to discuss is Bloomberg Intelligence senior tobacco analyst, that's Ken Shea in Princeton, and from Washington, Bloomberg News health regulation reporter Anna Edney. Ken, let me quickly just start with you. Altria, of course, we know is a pretty attractive target for Philip Morris, in part because of Juul. Is that sort of what was driving this merger?
Hi, Taylor. It certainly is one of the big factors. You know, I think there's three paths. One is greater access to U.S. Smokers that could convert to their IQOS platform. It could be Juul, and it could be the cannabis opportunity. Likely all three are really what's driving this potential recombination.
Anna, from your side of things over in Washington, generally, what's the regulatory pressure as you saw this news break? Is this deal likely to go through?
Well, I think one of the things I first thought of was that the Food and Drug Administration, they were pretty friendly to regulation of e-cigarettes for a while, and then when Altria took a stake in Juul, things started to change a little bit, and certainly there was concern with children and teens vaping, but also once Altria took that stake, the concern grew a little bit more because of the big tobacco interest and some of the comparisons there. And so I kind of thought when I first saw this deal that there's a possibility the FDA could decide they might want to come down even harder than they've already been considering.
So, Ken, I want to hit on something that Anna was touching on, which was about some of the comparisons in the market. We know that Philip Morris has a stake in IQOS, I believe it is, which is sort of a heat, not burn. How does that compare to Altria's stake in Juul, more of the e-cig market? What is your take in terms of A, the overlap, and then B, more the future growth of both of these markets?
Well, those are really good questions, Taylor. First of all, Altria's stake in Juul is a 35% equity stake. It paid about $12.8 billion. When it comes to IQOS, Philip Morris International's heat not burn product, it's really just the exclusive market or distributor of it in the U.S. And so a lot of people have been wondering, so what is the commonality? They're both vapor, non-combustible products. That said, they do target separate niches. Juul tends to be a younger adult, some even minors, unfortunately, as the FDA would point out. The IQOS product, because it uses finely ground tobacco as opposed to flavored liquid nicotine, it really, in my opinion, targets an older demographic who really looks to flavor the old-fashioned tobacco, almost like a pipe almost experience, as opposed to a nicotine hit. I think that's really the key differences between those two products.
And I think sort of broadly speaking here, talk to me about the regulatory environment down there as it comes to how people think about e-cigs. I have heard, perhaps on one hand, it's a gateway drug. Other people are wondering if the FDA thinks of it more as a replacement drug to cigarettes. Does that debate have a place here as we take a look at both Philip Morris and Altria as well, and some of the regulatory pressure that you see?
Yeah, I think it certainly does have a place in this debate because there is this balancing act that the FDA and sort of the government in general has been trying to keep up with. Hey, maybe these e-cigarettes are something that could help smokers quit. At the same time, they're seeing teens using them more and more, which they don't want because the Centers for Disease Control and Prevention has said that nicotine can have, harmful effects on a developing brain. And so they're trying to balance those things. Next year, there will be a deadline in May where these companies like Juul have to submit applications to the FDA to get approval for their products. So they have a really big milestone coming up that they're going to have to meet.
Wonderful analysis. Thank you. Bloomberg News reporter Anna Edney and Bloomberg Intelligence senior analyst Ken Shea. And coming up, we sit down with a Silicon Valley legend. Steve Wozniak shares his thoughts on the trade war, Facebook, and of course, the company he co-founded, that would be Apple. That's next. And if you like Bloomberg News, check us out on the radio. You can listen to us on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. We are getting some late news on Tuesday. Peloton has filed for its IPO. The company will seek a NASDAQ listing under the ticker PTON. Peloton filed with various banks, including Goldman Sachs and JP Morgan. The company also revealed it posted a 2019 revenue $915 million. Looking at a net loss of around $196 million. The loss is an increase from roughly $48 million back in 2018. Now, companies are, quote, hereby ordered to start getting out of China. That's what President Trump tweeted on Friday after China retaliated to his escalation of the trade war. Now, regardless of whether the president can actually force companies out of China, his trade war has highlighted just how important that country is to many tech companies like, for example, Apple. Now, the iPhone maker has been a gauge of sort of how trade sentiment is going, and there might not be an end to the turmoil no matter how many times CEO Tim Cook directly phones the president. To discuss this and much, much more, I welcome one of the iconic inventors from Silicon Valley, the man who co-founded Apple over 40 years ago. That would be Steve Wozniak. Steve, that introduction barely does you justice, but for the sake of time, we'll leave it there. It's great to have you. And as you sort of think about where we are in terms of trade and tariffs and the tweets, given your decades, multi-decades of experience, how do tensions in trade feel now relative to previous years?
Yeah, my experience is not in political areas or in economics or finance or anything like that. It's in engineering, you know, and I have opinions. But you know what? Two different people might come to different conclusions. Are the tariffs good idea? Are they a bad idea? Trade war, good idea, bad idea? And you know what? Both people would go down a line of thinking that's logical and connected. And that just means that all parties are good no matter which side they believe on, because we don't have a mathematics that proves one thing is better than the other. We just have opinions. I myself tend to fall into the camp that I don't want many tariffs. I don't want even things like subsidies very much. I want the free market to rule, but it comes from my own background. My own background was very much very compatible with growing up in Silicon Valley, where one of 10 counties in the United States where more than half the people speak non-English. Accept all types of people, work with them. I'm into cooperation more than competition. I put on a huge festival and sold 1 million tickets in 1982, 1983 in California, the US Festival, and we put out a whole policy, and we put out programs in books, and we put them in schools in all 50 states. And it was, you know, to think like John Nash, who the movie Beautiful Mind was about. And he wrote papers about cooperation, even in business, can lead to better results than competition. And I'm just into working with others and not seeing they are awful and bad. What is our country called? The United States of America. And states meant countries. We were going to have 13, now 50 little countries, each with their own rules, laws, you know, differences in culture. For example, slavery in some and not in others. That's how the Constitution was made. And so we're like a whole bunch of little countries. But I don't care if wood is manufactured more efficiently in Oregon. I'll buy my wood from Oregon. And we never think there's anything bad about that. Why do we establish borders for countries? I think it's just politicians are in charge of a country and want their own domain to be important. So I'm more of a sharing, you know, be very open in business and open to the world, and try to find ways to cooperate and you know, reach agreements that way. But still, whoever does the best job is going to have an advantage in you know, balance of trade.
You know, you mentioned competition. That word's come up 2 or 3 times in your answers, and that leads me to wonder if competition feels significantly more fierce this time around, and if that's what's sort of driving some of the tensions or the trade. Are you worried about competition from a Samsung, from a Huawei, sort of encroaching on perhaps Apple or some of the big market share?
Oh, I've thought about that and seen, you know, in my head many ways that it could happen and influence Apple negatively. But, you know, I don't say that there's one logical rule that comes to one answer for all. I just happen to be more against competition. We're taught from the time we go to school, my school, right or wrong, my team, right or wrong, you know, and that works your way up to my country, right or wrong. I'm more into thinking and determining what is right and what is wrong. And, you know, also be liked by everyone. Why do you want to be, I'm going to be nasty to you, I'm going to hurt you, I'm going to, you know, somehow throw my balance of force against you in a way. That doesn't make friends. We should try to be friends with all the countries of the world that are important, and certainly China's one of them. Now, as far as how it could influence Apple, well, everybody knows that a lot of the tech products, and especially things like smartphones and computers, the manufacturing shifted very much to China and the Shenzhen region, a lot of it in the world. You know, some of it's moving out to places like Vietnam now, but so what? That let us make products for a lower cost, and everyone who buys an iPhone pays less when it's that way. And so I don't see, why do we have to say, oh my gosh, the balance of trade is going in their direction? That's very common, especially for companies that are at China's level on the development curve, towards being a real major force in the world economies. Look where they've come from.
You know, Steve, you've talked about all being friends, and we note that Tim Cook has had sort of direct dialogue with the president. If you were still involved with Apple or Tim Cook, for that example, what conversations would you be having with the president? Are they productive?
I probably wouldn't, because I don't think with this president any can be productive. I would never raise a child of mine to be like that, I'm the most important person in the world. I'm the only one who is right in my thinking, and disdain everyone else and say bad words about them. I'm not that way, and I would not raise somebody. So I would just ignore it. I wouldn't say anything bad about the president. I wouldn't be nasty to him in his face and you should do this, you should do that. I don't think you can really direct him. I think Tim Cook, though, being a very important economic force in the United States, Apple is. I think Tim Cook actually gets the president's ear and a little bit, and can warn him, this might be bad in a certain way. For example, it was recently pointed out that if we suffered in a balance of trade with more expensive products, that might benefit Korean company Samsung or something like that. And that's an important thing to think about. That would be scary if we lost sales just because of that.
Right. Steve Wozniak, you are going to be sticking with me, because when we come back, we're going to take a look at the transformation of the company you co-founded, Apple. That's next. This is Bloomberg. An update to a story we discussed earlier in the hour. Former Uber engineer Anthony Levandowski has pleaded not guilty to charges with stealing driverless vehicle technology from Alphabet's Waymo unit. The 33-count indictment, announced Tuesday by federal officials in San Jose, adds a new criminal chapter to the saga surrounding Waymo's civil claims of trade secret theft against Uber. Now, the Apple IIe, the iMac, the iPhone, just some of the products that became household names thanks to Apple. But are things changing as Apple is shifting more and more money into the services sector, like credit cards and, of course, Apple TV Plus? Analyst Dan Ives sure seems to think so.
We believe this is key to the services business, and we think the opportunity here is 100 million consumers in the next 3 to 4 years, and that's really the golden goose for Cook and Cupertino. iPhone obviously is the meat and potatoes, but right now in services, that's key to the growth.
Who better to ask about Apple than the man who co-founded it? Still with me, Steve Wozniak. Steve, what is your take on how Apple has sort of transitioned from a hardware company into now more services?
I'm actually very proud of Apple as a company because of the fact we have been able to transition. We started out with the name Apple Computer, and then as we moved into products that were more personal in nature, like iPods and iPhones, we dropped the computer from our name. And being flexible and being able to shift with the demands of the market is very important for a modern, ongoing company that's really going to make it. So moving into services, if that's where a lot of the business is. Apple's a huge company, and we have to move. And so Apple can only move in directions that are going to be very large in dollar volume potentially. And we've moved into some other hardware products like watches. Heck, that's about my favorite piece of technology in the world right now. But the services, when Apple Pay came along, you notice that Apple took a lot of steps leading the industry. Things like Touch ID, and then all the other smartphones had to copy it. Now we have Face ID. But then we took the Touch ID and moved it into Apple Pay, a system that really protects your identity in your credit card purchases everywhere. And it's also so unbelievably easy, especially if you have a watch, you just pay so easily. And you know what? But that's important. Making life easy is what we were known for in computers. These were computers that you didn't have to be an expert to use. And now Apple Pay, the Apple credit card, is even more secure. First of all, the looks of it fits Apple's branding. Apple's branding is to have a lot of, secrecy about what they're doing, but also styling and beauty and things like that. This card is just the most, beautiful card I've ever had in my life. And I don't even judge beauty that way very much. I don't put a high value on it. I don't. But it is. And it doesn't even have a number written on the card. There's no camera that can peek at you using the card, even in an ATM, and somehow see what your credit card number is. There's no way that people in a retail store ever get your credit card number. And so it continues that thing of protecting your privacy. Everywhere you go, what you buy and where you buy it is, shouldn't be really tracked that closely in my mind. I don't want it. I don't want to. What could you use? Oh, we see that you bought, a milkshake 2 hours ago. I don't want somebody coming up to me and saying that.
Well, Steve, I want to get to privacy. You're giving us a free advertisement because you keep flashing your iWatch around. And if I heard you correctly, you said it's one of your favorite pieces of technology. The iWatch, when it came out, was, let's call it mediocre. Since then, though, it has really grown and become a key piece for Apple. Are they doing the right thing with the Apple Watch, incorporating some of the health services into that?
I'm not a biggie on health services, but yes, everywhere I go, people are, using it for health services and information. That's one of the pieces of it. The Apple Watch has so many pieces that make it so comfortable for me. I can be walking my dogs, not have to carry a phone, not have to use a phone even. We got the iWatch now when it's on LTE cellular. I can text my wife, walking the dogs, Ziggy just pooped, whatever. But Apple Pay is the best. I can put my movie tickets on the watch. I can put my boarding passes for flights on the watch and do email. I get notifications all the time, and it's great to see what's happening around home. I don't know what. I go from my computer in a hotel or at home, my computer to do efficient email and whatever and keep up with news going on in the world. And then I move to the watch and I pretty much skip the phone. I'm not one of these people that wants to be like an addict, going along. Steve Jobs and I started this company trying to make blind and sighted people more equal. And we succeeded because everywhere you go, look on the sidewalk or in front of you in your car on the street and there's people walking along not seeing anything except their phone. So I don't want to be in that habit area, that addictive type area. So I pretty much skip the phone for most things, except maybe occasionally checking in or Steve, an important message.
Quickly, I have to ask you, with $200 billion of cash on the balance sheet, what should Apple do with it?
I never even think about that. I do not want to think about money and large amounts of it and where to put it. I think Apple's been doing a very, very fine job. First of all, Apple makes a certain amount of money, profit, return on investment, and you've got to look for investments that will keep that return level high. That's what the Apple brand is partly based on. So I hope Apple's, I trust businessmen that know a lot more about business than I do are inside of Apple.
Okay, well, stay with me because when we come back, we will hear more from Steve Wozniak about the growing question of whether or not big tech has actually now gotten too big. That is next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in New York. While the U.S. presidential election is still more than a year away, one topic that will not go away, big tech meets antitrust regulators. And on Monday, Democratic presidential candidate Bernie Sanders weighed in an op-ed in the Columbia Journalism Review, saying, quote, "When it comes to Silicon Valley, I will appoint an attorney general as well as a Federal Trade Commission official who more stringently enforces antitrust laws against tech giants like Facebook and Google to prevent them from using their enormous market power to cannibalize and defund news organizations. Their monopoly powers particularly harm small and independent news outlets that do not have the corporate infrastructure to fight back." Still with me, Apple co-founder Steve Wozniak. Steve, what's your take on antitrust? Is big tech too big?
I'm one of the four founders of the EFF. So I am really against monopoly powers being used in unfair antitrust manners, not opening up the world to equal competition, using your power in unfair ways. And I think that's happened a lot in big tech, and that they can get away with a lot of bad things. Everywhere I go, people love technology aspects of it, but then they always find other things to grieve about, whether it's, difficulty to use and I don't have any choice and I'm kind of forced into this mode and things change and I have no control over it. And there's an awful lot. A company that has a strong presence in one market, using that presence to grow another market is sort of unfair. The example that I used to use long ago was, well, if you owned all the gas stations, and then you said we're converting the nozzles of all of our gas stations, and they will only work with a new car that we're coming out with, that would just be unfair. That would be, using your power in one market to subsume another. And we see this all over the place. I mean, just apps that come standard with products like phones, do that to an extent. So I'm pretty much in favor of looking into splitting up companies. I mean, I wish Apple on its own had split up a long time ago and spun off independent divisions to faraway places and let them think independently the way Hewlett-Packard did when I worked there. But that's my opinion. It's not like there's one set of facts that makes it right. Other people could come to other conclusions. But I think that big tech has gotten too big, it's too powerful a force in our life, and it's taken our choices away.
Steve, what is
it's hard to escape.
Prescription then to break up big tech? Selling off pieces of Apple, selling off pieces of Facebook? What would be your prescription?
I think Apple's the best of the companies for a lot of different reasons, caring about the customers and just making money off good products, not really tracking you and following you. But I think a lot of other companies should be, like especially Google and Facebook, allow competition. In the example of Facebook, give me a choice to pay for almost no tracking, and explain to me, yes, if I let a friend in that's not really a good friend, they may get some of my data that I didn't want them to, but I made a mistake. That's fine. Or Facebook, or force them to have an ability to easily export a file that you could export into a new book, and it would bring along all your friends. That's the most important thing, as well as your timeline and your other data. And you could just tell all your Facebook friends, come on over to New Book, and we're instantly still in the same friends groups. That would enforce competition. Competition forces a company to make good products and be the best at it, and not just say, we've got you trapped.
Steve, is data the biggest concern here? Is that what worries you the most?
The data that's accumulated on people.
Big data,
it should be done. Yes, it does worry me. I wouldn't say the most. A lot of things worry me about big tech. But in cases of data about you personally, and like tracking you and things like that, that's only one factor. And to some people it doesn't matter, and to others it does. What it should be is honesty. I rate good in the world, doing good things, as honesty is at the peak, the very peak. And if you think you're getting one level of protection of your security and your safety and knowledge about you, you should be getting that level. If you send mail to somebody and say a few little things, hey, my favorite color is green to my wife, well, that should be kind of private. It's kind of like whispering in an ear, and it shouldn't be that anyone else ever had access and heard it. Look what we hear about, Amazon Alexa and even Siri, where human beings listen to data that's recorded. That's beyond what you think's going on. You think you have a level of privacy, you should have it. I'm always for the consumer over the producer.
Steve, when we transition to talk about cryptocurrency, is it the future or all hype?
Cryptocurrency, of course, Bitcoin is an amazing example. And, and it hasn't been hacked or destroyed or messed up with the software. It's really lasted and done its job for, I don't know, a decade or whatever. You never heard of any technology that, had code that was that secure. Bitcoin is gold. But then a whole ton of other people, 200 other companies that have their own little coins that want to be currency. And I don't believe in that. I don't like to track stocks. I've never used Apple stock app. I don't want to look at Bitcoin prices and invest in it. However, I'm getting involved in a couple of startups now, and that's not my reason for being here today, but a couple of startups based on blockchain, which is the technology that makes things like Bitcoin work, but our blockchain will have tokens that aren't the equivalent of cash. It's not like you trade a token, it just becomes artificial cash. No, it's like the tokens are representative of ongoing, efficient companies that are very profitable now. I'm very conservative economically and financially, and so I'm only getting involved in these to basically have another financing arm for companies that are already very profitable and making money.
So then talk to me about Facebook's Libra. Do you perhaps see those as a competitor if you're having some money invested in other cryptocurrencies or the blockchain technology? What's your take on Libra?
Oh, no competitor at all. It's kind of like, what I'm talking about is where your tokens, your cyber tokens, are just like shares of stock in a company that's ongoing making money. Now, Libra, I think, is just, I don't know. I don't even know the principle behind it, but I'm sure that it comes into that category of antitrust, because you've got so many clients using your product. Oh, all of a sudden, we'll get them into our cryptocurrency, we'll challenge Bitcoin. I don't know. That's just a whole department that should be done independently with competition, and, so let's see how that goes. I'm not really against it, but I'm against any bad uses, implementations, not giving your users choice or knowledge. Be honest. At least be transparent. Well, transparency is the best thing you have. In
terms of transparency, you were honest enough to come and talk about some of your new ventures and caveating it with the fact that that's not why you're here. But because you gave us a teaser, talk to us about some of the new adventures. What can we expect from you in the coming months and years ahead?
I actually do a lot of public speaking around the world, but right now I do have about 4 startups going on. I like startups, young companies with an idea, trying to make something out of it, much more than the big, huge tech companies. And, one of them, Silicon Valley Comic-Con, and another is WazU. It's a university for technical education. I'm proud to have my name attached to such a thing. I'd wanted that for a long time. I also, and a couple of these are blockchain. We're going Malta. We're going to do stuff. There are countries like Malta that desperately want to become known for well-regulated and very open but very usable blockchain companies. So we're choosing Malta for one, and Gibraltar worked it into their exchange for another company. Those companies are called Equi and F-Force. But I don't want to. I'm not here to promote myself or promote them. But no, I have a busy life still.
Well, this was wonderful. It's our pleasure. Steve Wozniak, thank you so much for joining me today. As I said, being the co-founder of Apple barely begins to describe your decades of experience. I appreciate it.
Honored to be here.
And coming up, U.S. stocks closed lower on Tuesday amid uncertainty over U.S.-China trade talks. We'll discuss which tech companies have been most impacted by the dispute next. This is Bloomberg. HPE shares are up in after-hour tradings after the company gave a profit forecast that topped Wall Street estimates. The company reported third-quarter earnings Tuesday that beat analyst expectations, while revenue declined 7% to $7.2 billion, missing estimates. HPE also raised its full-year earnings guidance, signaling progress in its effort to cut costs and reshape its business to high-margin products. And U.S. stocks slipped again Tuesday as investors digested the most recent twists in the ongoing U.S.-China trade talks. The S&P 500 fell for the third time in 4 sessions after Chinese officials questioned President Trump's comments about trade discussions between the two countries. This is the day after, of course, that Trump said Beijing very badly wanted to make a deal. Tech and chip stocks, including Apple, Qualcomm, and Micron, have all been among the hardest hit throughout all of these trade tensions. Joining me to discuss this, National Holdings Chief Market Strategist Art Hogan, and also the Peloton news that we got, perhaps seeking to file its IPO. As we talk about some of these unicorns who you see some revenue growth, but you just continue to see losses on the bottom line, are you nervous at all about that?
Yeah, we get kind of nervous. We look at some of these companies that come out and wonder, A, did they stay private too long? So that some of that amazing growth, that early growth, wasn't captured by the initial public investor. And I think that the other piece of the puzzle is, yes, Amazon was able to go for a long period of time of growing revenue and never really showing earnings, but I think that time frame is behind us. I think investors have proven, whether it's through Uber and Lyft and some of the other unicorns that have come out, it's like, hey, there's got to be some point in the future where this inflects to cash flow positive. Well, and just how much growth and revenue are we going to actually pay a multiple for? Well,
and one of the things that concerns me as we sort of dig through the filing that we're getting about Peloton is it says we expect to incur operating losses in the future and may not achieve or maintain profitability in the future. What is the path to profitability? Are we overvaluing some of these companies, given, frankly, they can't make money?
Right. Yeah, it's interesting. So you look at the different business models. We mentioned a couple of those, and not sure, where rideshare goes to get profitable at some point in time. And I think Uber's got some plans to do a lot of other things logistically. But with Peloton, the question you have to ask yourself is threefold. Right now it feels like there's a real cult following around that stock and that, in and of itself, that lifestyle. So I think it's got some runway. It also feels like there's a creative mode around it, because I think that people that are involved in the Peloton experience are involved for a lot of reasons, not just exercise. But at the end of the day, how much scale do they have to grow to get enough of their total addressable market to actually turn a profit? And is this the time that they should be coming public, or should they be staying private longer until they can have some window into what makes them a profitable company?
Another, of course, big story of the week, of the year, of the last few years has been trade and tariffs. What companies, as you sort of digest the landscape, should you be or not be targeting as you take a look at what companies can or cannot do well within the midst of the trade fight?
Yeah, it's amazing. Semiconductors are front and center on this battle line. They are the tip of the sword in this trade war, and that's amazing. When you look at the Philadelphia Semiconductor Index, for the period of time, you can actually point to the inflections and trade tensions at different levels. So the peak to trough in May, when things fell apart and we escalated from 10 to 25%, the semiconductor index went down 18%. The broader market went down about 9%. So you're seeing a doubling of the volatility in semiconductors, and there's a lot of reasons for that. So they're indexed to China twice, right? They're indexed to China because they get parts manufactured in China, but China is an end market for them. So when we look at that semiconductor index, we say, why would you step in the middle of this fray with the blunt instrument that is at the tip of this fight when you can step back and have other exposure to technology? When I think software as a service, SaaS plays are much safer. And if you did an overlay of the SaaS, the Bessemer SaaS or the Bessemer Cloud Index versus the SOX, there's been much less volatility. And why is that? Because it's a much more consistent revenue flow, right? So you don't have that sort of comings and goings. You're not as indexed to China, and it's a safer way to be exposed to technology.
So is it as simple as sell Qualcomm by Salesforce, or is there much more idiosyncratic fundamental analysis that needs to be going on?
Simply stated, I think that's the perfect way to look at it. Now, you can pick a multitude of which one of those companies you can buy and sell both of those indexes, right? And do an overlay and do a pairs trade. But I think right now, while we're in the heat of this, and it doesn't appear as though we're closer to the end of this U.S.-China trade war, it feels like every day we're taking one step forward and two steps back. I would avoid the semis at all costs. And if you have to have technology exposure, and most of us want some technology exposure, think about SaaS companies that don't have that indexing to China.
We just spoke with Steve Wozniak, co-founder of Apple. You joked he's a tough act to follow, but I'm going to put you on the spot anyways. So talk to me. He talks a lot about big tech. Frankly, we need to be breaking up big tech, particularly Facebook.
Right.
Do you agree?
Whether I agree or not, it's going to be an issue, and it's going to continue to be an issue through 2020 and the election cycle and probably afterwards. And only for the fact that they've had enough opportunity to get things right in terms of keeping our data safe that they've really whiffed on. And I think that's a huge part of the problem. And the second part of that is this is a bipartisan agreed argument that's going on right now, that perhaps not only have they gotten too large, but they're not doing a very good job of keeping us safe, whether it's our elections or our personal data safe. And so we continually hear this Facebook is going to be looked at by the regulators. They're not alone. It's all of social media. They're not going to pick Facebook out and say, hey, you guys are the bad actors. It's going to be the whole group. But it's keeping our data safe. And unfortunately, their product is us. And if they keep us safe and operate in an environment where they aren't able to continue to do that, then they're going to be under pressure.
Quickly here, talk to me about some of these old companies, Apple, Microsoft, transitioning from being hardwares into cloud services. Have they done a good enough job?
They've done an amazing job. Cisco is a great example of that. Recurring revenues for Cisco used to be 3%. It's in the teens now, and they did that in a function of 12 calendar months. It's an amazing transition. You're seeing that reflected you're seeing the same things reflected in Microsoft. What a fantastic job they have shifted to the cloud. And Apple is looked at as a services company. It's not a hardware company anymore. All of that's very exciting for investors. I think you have to take a different look at these companies today than you did a year ago.
Well, so much energy about the tech sector. That was great. Thank you so much. National Holdings Corp Chief Market Strategist Art Hogan, thanks for joining me. And still ahead, we take a look at China's booming music industry. One name has become a hit, but is China's regulator a fan? This is Bloomberg. Now to a story we brought to you earlier this hour. Interactive cycling company Peloton has filed for an IPO. It is the latest in a string of tech companies who have made moves to join the public markets this year. Joining me to discuss from New York, Bloomberg News deals reporter Nabila Ahmed. Nabila, as we give you a cool 13 minutes to sort of brief through this, give us your first take. What do you make of this?
Look, investors were waiting to see what the numbers would look like. We've seen about $6 billion raised by pure play tech companies this year. A lot of those companies are up, but then you've got Uber and Lyft, and performances for some of those sorts of companies haven't been that good. And, you know, as expected, Peloton's numbers show that this company is obviously not profitable,
right?
But their revenue is growing very fast. So their total revenue growth in the past couple of years was up 99% and 100%, 110% year on year. Their net losses, though, were last year $195.6 million.
And as you say, that's up from just $48 million in losses the year before. So losses are growing. And interestingly enough, in this statement, they say we expect to incur operating losses in the future and may not achieve or maintain profitability in the future. As you look at Peloton and some of the other deals you've covered, what is concerning? The fact that they're literally saying we may not be profitable?
They're all saying that, right? So investors have to figure out whether that is worth sort of buying into it anyway, because these are high growth companies, so they're choosing not to be profitable for now. However, they're pulling in the revenues, and, you know, once they get to a certain level, they can probably, you know, start to make some profits. But as you say, it's really concerning when a company says, hey, please buy our shares, but we may never be profitable, and they're saying they're not obviously going to be giving a dividend either.
Any idea what this means for the banks? We know that they, for now, have looked at an offering size of $500 million, though that could be just a placeholder. Goldman, JP Morgan, B of A, Barclays, UBS, Cowen, some big names involved. What do the fees look like?
Well, so the $500 million is just a placeholder, as you say. This company will be valued at probably around $8 billion. And we'll find out, you know, in the coming weeks how much they'll actually look to raise from this.
Wonderful. Wonderful reporting, Nabila Ahmed. Thank you for joining me. And also, another big story, Tencent Music is under investigation by China's antitrust authority. That's according to sources who say the probe could end exclusive licensing deals the company has been forging with some of the world's biggest record labels. So how did Tencent Music become so dominant? Joining me to discuss from Los Angeles, Bloomberg News reporter Lucas Shaw, who covers all things streaming. Lucas, how concerned is Tencent Music today?
I'd say the concern is moderate. On the one hand, it's never good to have regulators looking at you. Tencent's in a pretty dominant position across the online media landscape in China, and in particular in music, for all of its success with its WeChat app and in video gaming. You know, Tencent's 3 music services account for anywhere from 55 to 75% of the streaming market in China. But this investigation, the outcome would likely result in them just not striking exclusive deals. See, the music market in China works totally differently from how it does in most parts of the world. Here, the big record labels, they license their music to Spotify, they license their music to Pandora, they license their music to Apple. A lot of those services don't operate in China, and instead what they do is they sell Tencent the exclusive rights, and then Tencent sub-licenses it to other companies, all of whom say Tencent's paying too much, passing along the charges to them, and basically making them all suffer for some bad deals that it made.
Lucas, what has Tencent said in response?
So, excuse me. So far, they've said very little. I think they're waiting to see how it plays out. This investigation started earlier this year, January, February. A lot of the people that we spoke with said that there was an outreach to kind of competitive services and their partners in March and April, and there may be some kind of outcome later this year. My guess is that Tencent is going to kind of try to keep a low profile until they figure out what this will mean for them in the long term.
Any idea what the record labels, the music labels who are involved in this as well, what is their impact?
You know, they have a lot on the line here because China is a market that many years ago was kind of a non-factor for them. There was too much piracy, nobody paid for music. It has grown a lot in recent years. And for that to keep growing, they need deals with all these services, and they're going to have to renew their deals with Tencent or make deals with rivals sometime in the next 6 to 12 months.
How good is this for competitors? I'm taking a look at some of the lists we have. Alibaba, Baidu, ByteDance. How thrilled are they?
companies like Baidu, Alibaba, and in particular NetEase, which a lot of people say is kind of the real challenger to Tencent in China, would be very happy if instead of having to sub-license from Tencent, which means that they might not get all the songs that they want at any given time, they could just make direct deals with record labels. You know, when I was based in Hong Kong for a few months late last year, and the executives at NetEase were very clear that they hated the exclusive structure because it just gave Tencent an advantage. And most of those music companies that didn't go the exclusive route, not the big three, but kind of independent labels, they said that they tended to benefit when they made deals with everybody because they had more transparency in their data. The downside of the deals, of kind of exclusive deals with Tencent, is that Tencent really has a lot of control over what happens with that music in a country where Western music still only accounts for 10 or 15% of all listening.
And Lucas, remind us, how much does Tencent Music mean to Tencent Holdings?
You know, it's a big deal, but think about it as Tencent Music is at the moment like a $25 billion company, where Tencent, depending on where the market is anywhere from sort of a $300 billion to $500 billion. Areas like gaming and in particular the social app WeChat are still much bigger for Tencent. But music helps feed into that, because one of the things about WeChat is it's a super app where they want you to come in there and chat and watch video and watch music. And so Tencent has staked out a leading position in areas like streaming video and streaming music to make sure that people never leave WeChat. If it loses its dominance in those other media areas, then the strength of WeChat on its users is weaker.
All things streaming. Thank you. That was Lucas Shaw in Los Angeles. That does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.